The rise in overall interest rates is going to drive the cost of mortgage financing higher. We've already risen from about 3.5% on the lowest rate 30-year fixed mortgages to around 4.5%. I would expect to see that number head up to 5.5% or 6% later this year as the economy improves. Now, the generally improving tone of the jobs market, in theory, should help housing, but if a lot of people have only been able to afford homes because of rock-bottom interest rates, that really isn't going to hold water in this cycle. We're likely to see housing struggle as the year goes on, and housing stocks, those levered to housing or construction or mortgage lending, tend to underperform or even decline in value, even as the overall market tends to go up because of an improving economy. So long story short, rising interest rates will be bad for housing and also bad for the investment buyers who have flocked into the housing market in the last couple of years. They've really been purchasing housing to rent it out, and housing has been behaving like sort of a bond. So as bond prices go down and interest rates go up, you're going to see a lot of those investors back out of the investment real estate market, and that will hurt values as well. Many observers on Wall Street and at the Fed expect inflation to remain tame throughout 2014 and beyond. But I think we have a lot of the tinder there, the dry tinder out there for a rise in inflation. All that was waiting to ignite that tinder was an improvement in the overall economy. And now we're starting to see that happen. We've really been seeing that happen for most of a year, the better part of a year now. So as the economy picks up, employment picks up, wages start to pick up slowly but surely, I think you're going to see inflation feed through in the system, especially as we head into late 2014 and 2015. So that rise in inflationary pressures could give a real kick to this increase in interest rates later on in the year. We've seen many of the big banks report decent earnings as a result of the reduction in loan loss provisions. Some of that may be just padding the bottom line, but some of that is resulting from the improvement in overall credit quality. We also have some other accounting gimmicks going on there, and investors are generally ignoring things like the rising cost of lawsuits for mortgage settlements, LIBOR manipulation, and everything else that we've seen over the past year. All of that being said, many core banks, especially regional banks, should benefit as interest rates go up because I expect long-term interest rates to go up at a faster rate than short-term interest rates. That tends to widen the spread or difference between what a bank pays to get money from depositors and turns around and lends that money out to borrowers that it serves. So as that margin widens out, it's just like the profit margin of any business increasing, and that should be generally bullish for safer banks and bank stocks.